Right now, as of 10:21 a.m. Eastern on this Monday, November 10th, Applied Digital Corp, ticker APLD, is trading at $32.91. That's a significant move up, gaining $1.93 or just over 6.2% for the day. Volume is already heavy at over 6.2 million shares, well on its way to matching its daily average as money pours in. Now, most people who have followed this name see that and immediately think it's just another volatile day for a crypto-related stock, a name you'd trade for a quick flip on your Robinhood app or perhaps on SoFi Invest. The long-standing expectation has been simple. APLD is a proxy for Bitcoin, a speculative digital infrastructure play that swings wildly with the sentiment of the digital asset market. But the reality of what is happening today and what has been building for months is so fundamentally different that it forces a complete reevaluation. Today's 6% jump isn't about crypto. It's about a massive $2.35 billion debt offering announced this morning, a move that confirms this company is in the middle of one of the most aggressive business pivots on the entire market. The common belief about APLD is rooted in its past. For the longest time, it was correctly identified as a company building and operating data centers primarily for cryptocurrency mining. Its revenue and its stock price were heavily tied to that industry. If you were a believer in online investing and wanted a picks and shovels play on crypto, APLD was on your list. It was seen as high-risk, high-reward, and not the kind of stock you'd ever expect to see in a long-term managed Schwab Intelligent Portfolios account. It was the antithesis of a stable blue chip like Apple stock. But here is the challenge to that entire thesis. That company doesn't really exist anymore. The market is slowly and painfully trying to reprice APLD, moving it from the crypto mining bucket to the AI infrastructure bucket, and the transition is creating enormous friction and volatility. The company you thought you knew is not the company that is trading today. Today's 6% jump isn't about crypto. It's about a massive $2.35 billion debt offering announced this morning, a move that confirms this company is in the middle of one of the most aggressive business pivots on the entire market. Let's look at the recent trading action because it tells a story of a brutal battle. This stock is not for the faint of heart. If you're using the SoFi investing tools or the Fidelity mobile app to check your positions, you've seen this stock swing wildly. The 52-week range tells you everything, a low of $3.31 and a high of $40.20. The stock has surged over 300% in 2025 alone, but it's been a nauseating ride. A key reason for this volatility is the massive short interest, which last stood at over 24%. That is an enormous percentage of the float. This means a significant portion of the market is betting heavily against the company, likely holding on to that old crypto miner narrative. They are betting that the company will fail to execute, that the financing will fall through, or that the AI contracts won't materialize as promised. Today's $2.35 billion offering is a direct broadside against that bear thesis. The 6% jump we're seeing is not just new buyers. It's very likely a contingent of shorts getting squeezed and being forced to cover their positions. This creates a feedback loop. The stock rises, the shorts feel pain, they buy to close, and the stock rises further. This is a classic show-me story. The company's last earnings report on October 9th was a perfect example of this tension. They reported fiscal first quarter 2026 results with 84% revenue growth, which is a fantastic headline. But at the same time, gross margins disappointed, coming in lower than expected. This highlights the reality of their situation. They are in a capital-intensive, low-margin build-out phase. They are spending enormous investment capital to build the foundation for future high-margin, long-term contracts. This isn't like NVIDIA stock, which sells the high-margin chips. This is more like a utility, building the power plants and transmission lines for the AI revolution. It's a tough, dirty, and expensive business, but if successful, it creates a wide moat with recurring, predictable revenue for decades. The institutional ownership reflects this high-stakes disagreement. Over 500 institutions own the stock, but we've seen massive position changes. Some funds like Oasis Management sold off huge stakes, while others like BNP Paribas initiated massive new positions. This isn't quiet accumulation, it's a high-stakes debate being played out with billions of dollars. So what does Applied Digital actually do now? Let's briefly reset the business model because it's crucial. The company designs, builds, and operates next-generation digital infrastructure. It has two main segments: the legacy data center hosting business, which still serves crypto miners, and the new high-growth HPC hosting business. This HPC segment is the entire story. They are building massive campuses, like the ones in North Dakota, specifically designed for the enormous power and cooling needs of AI applications. They provide these facilities to hyperscale cloud providers and AI companies like CoreWeave, which then install their own servers and high-powered NVIDIA stock GPUs. APLD is essentially becoming a specialized landlord for the AI industry. Their Polaris Forge 1 campus just saw its first phase go live for CoreWeave on October 27th. This pivot is why analysts, who are paid to look forward, are almost universally bullish. We have a strong buy consensus from 10 analysts, though the stock is now blowing past many of their $31 price targets, which will force them to update their models in light of this new financing. This brings us to the future outlook, which is where the expectation versus reality framework becomes paramount. The expectation from the bears is that this is a house of cards. They see a company that is still losing money with a negative EPS of -$1.14, taking on $2.35 billion in new debt in a high interest rate environment. They see execution risk everywhere. What if construction is delayed? What if energy costs spike? What if their major clients back out? These are all valid risks, and they are precisely why the short interest is so high. This is not a stock for someone who wants investment help through a simple robo-advisor. This is a name you'd trade using the complex order types on a platform like Interactive Brokers, where you can manage your risk with precision. It's not a set-it-and-forget-it holding for your Fidelity IRAs. The path to failure is clear. If they failed to execute on this build-out, the debt load could become overwhelming and the stock would collapse. But then there's the other side. The reality the bulls are investing in is that APLD is securing its position as a key infrastructure provider for a multi-trillion-dollar technological shift. The bulls see the $5 billion AI factory lease and the massive CoreWeave contracts as just the beginning. They see the $2.35 billion debt offering not as a risk, but as a stamp of approval from sophisticated credit markets that believe in the company's ability to generate the future cash flow to service that debt. If this bull case plays out, the company's revenue won't just grow, it will compound at an explosive rate. The current $8.7 billion market cap could look laughably small in a few years if they successfully bring their 400 megawatts plus of HPC capacity online and fill it with long-term high-value contracts. This isn't a stock you'd compare to Tesla stock in terms of product, but it is similar in its polarized nature and its grand capital-intensive vision. As an individual investor, this is what you have to weigh. Are you looking at this through the Robinhood stock trading lens, seeing a volatile chart to trade? Or are you looking at it through a Fidelity Wealth Management or individual brokerage account lens, asking if this company has a durable, long-term competitive advantage? The path forward for APLD is binary. The tension between the $3.31 low and the $40.20 high is the market's way of screaming that it has no idea how to price this transition. Today's news heavily favors the bulls. It provides a clear line of sight to a funded business plan. It challenges the "they can't fund it" bear thesis directly. I have to ask you, and I really want to know what you think. Comment below with what you believe is the biggest risk for APLD right now. Is it the $2.35 billion in new debt, or is it the execution risk of actually building these massive data centers on time? In summary, the story of Applied Digital today is one of profound transformation. The stock price is moving higher not on vague crypto sentiment, but on the very real, very tangible news of a $2.35 billion financing package to build the backbone for the AI industry. The old expectation was a speculative miner. The new reality is a capital-intensive, high-growth infrastructure company that has already signed the contracts and is now securing the funding to fulfill them. The massive short interest remains a powder keg, and today's move could be the spark that ignites a much larger squeeze. This remains one of the most fascinating and polarized stocks on the market, a perfect case study in a market struggling to price a company that is fundamentally changing its identity right before our eyes. The risk is immense, but the potential scale of the opportunity, if they succeed, is just as large.